USHY's 16% crash versus JAAA's tiny 2.6% drop reveals which fund actually behaved like a real bond during chaos. But here's where it gets interesting. USHY's recovery took 3 times longer than JAAA's over a year of watching your investment stay underwater while waiting. Now, let's shift gears and look at total returns over 5 years, reveal the real winners. This is where we'll see who actually delivered for investors. Let's zoom in on this. JAAA delivered a solid 25% return over 5 years, consistent gains without the wild swings that keep investors up at night. USHY delivers that 24% long-term return we're tracking, nearly identical performance, showing this fund's staying true to its benchmark consistently. In plain English, over 5 years, both funds finished neck and neck, a dead heat. Like marathon runners crossing the finish line together, their long-term returns are virtually identical so far. Let's break this down further. Looking at recent performance gives us a clearer picture. One fund's pulling ahead while the other's losing ground fast. But here's where it gets interesting. USHY's surging ahead with a 33% gain. That's the kind of acceleration that separates winners from the pack in this race. Now for the real question. JAAA's trailing at 23%. That 10-point gap shows it's falling behind in this race, struggling to keep pace. In plain English, USHY's been flooring it like a race car lately, accelerating hard in recent years, while JAAA's just cruising on autopilot. Totally different momentum styles between these two. Here's where things get revealing. The one-year window tells us where momentum lies right now, and USHY's clearly pulling ahead of the pack. Now let's put this in perspective. USHY crushed it with a 9% gain this year. That's solid momentum you don't see often in high-yield bonds. But wait, there's more to this story. JAAA's 5% return is disappointing. Barely half of what USHY delivered, showing clear underperformance in this matchup. In plain English, USHY's racing ahead, while JAAA's falling behind. Momentum is everything in this race. When one fund's accelerating and the other's sputtering, you're watching market forces pick their winner in real time. Let's take a closer look. Raw returns are flashy, but they're hiding something critical, the actual risk you're taking to get those gains. Now here's where it gets tricky. A Sharpe ratio of 0.5 means you're getting half a point of return for every unit of risk, solid risk-adjusted performance. But that's not the whole picture. A Sharpe ratio of 0.1 means you're barely getting rewarded for the risk you're taking on here. In plain English, risk-adjusted returns reveal efficiency. Think road trip here. USHY burned 5 times more risk fuel to travel nearly the same distance. For long-term investing, that inefficiency adds up. Efficiency always wins. Here's what really matters. A Sharpe ratio of 2.3 is outstanding. You're getting exceptional returns for every unit of risk you're taking on here. Now, let's connect the dots. USHY's improved to 1.1, better than its history, but still only half as efficient as JAAA's delivering income to investors. In plain English, think of risk efficiency like a race car's speed-to-control ratio. JAAA doubled its performance recently, becoming the nimble speedster, while USHY improved but still handles like a heavier vehicle on the same track. All right, Pause here. Who's winning this battle? Drop your vote. JAAA or USHY in the comments. Here's the key takeaway. The Sortino ratio's smarter. It only penalizes you for downside drops, ignoring upside swings that actually help your portfolio grow. Now let's flip the script. JAAA's Sortino of 0.5 shows it cushions downside risk better than USHY. You're getting smoother protection when markets drop. But there's a catch. USHY's 0.2 score shows it struggled badly with downside protection, meaning it couldn't shield you when markets dropped hard. In plain English, when the market storm hits, JAAA provided more than double the shelter compared to USHY. It's like having a reinforced roof versus a leaky one when trouble brews. Let's dig into the details. JAAA's 3-year Sortino ratio of 1.9 shows it's crushing downside risk while maintaining solid returns. That's exceptional protection. But here's where it gets interesting. USHY's improved to a 1.6 hit score, but it's still not matching JAAA when markets drop and investors need protection most. In plain English, both funds have beefed up their downside protection lately, but when the storm clouds roll in and markets get choppy, JAAA's still your sturdier shelter against the turbulence. Here's where things get revealing. JAAA's worst drop was just 3%, while USHY crashed 16%. That's 6 times more pain during downturns. Here's where the story takes a turn. USHY's recovery dragged on for 450 days, over 3 times longer than JAAA's 146 days. That's an extra year of dead money. In plain English, think of it like marathon runners recovering between races. JAAA was back on track in 5 months, while USHY took over a year. When markets crash, recovery speed directly impacts your returns. Now, for the real question. Dividend yield is critical if you're retired. It determines how much actual cash you're pulling from your portfolio each month. Now, for the real question. USHY's delivering a solid 7% annual yield. That's serious income generation when you need cash flow working for you right now. Let's dig into the details. JAAA's 5% yield is solid income, but it's trailing USHY by 2 full percentage points over this period. Here's the tale of 2 strategies. USHY gave you 10% more return over 3 years, but crashed 6 times harder. Meanwhile, JAAA delivered double the risk-adjusted performance with its superior Sharpe ratio. In plain English, USHY's yielding 7% annually versus JAAA's 5%. That's an extra $2,000 per 100,000 invested. It's like finding couch change that actually adds up every single month. But wait, there's more to this story. Dividend growth over 3 years tells you which fund's actually building income, not just promising it today. Here's the thing, though. JAAA's dividend growth absolutely crushed it. 54% over 3 years means your income stream nearly doubled while you held it. Let's take a closer look. USHY's dividend growth crawled just 10% over 3 years. That's stagnant income when you're counting on bond payouts to grow. In plain English, think of it like a report card. JAAA's crushing it with an A+ at 54% over 3 years, while USHY's barely scraping by at 10%. That's the difference between excellence and just getting by. But that's not the whole picture. Fees silently steal your compounding power. What seems small today becomes a massive drag on your wealth over time. Let's see how this plays out. USHY's 0.08% expense ratio is ridiculously low. You're keeping more of your bond returns instead of paying hefty management fees. Here's what really matters. JAAA's fee is double USHY's at 0.2% annually, but it's still reasonable compared to most actively managed bond funds out there. In plain English, think of fees like a tax on your investment. JAAA charges $200 per $100,000 annually, while USHY takes just $80. That $120 difference compounds significantly over decades. But hold on a second. Alpha separates the managers with real skill from those just riding the market's coattails. Here's where luck stops mattering. Let's unpack this a bit. JAAA crushed expectations with 4.3% alpha over 5 years. Returns well beyond what you'd expect from its risk profile. Here's the key takeaway. USHY's negative alpha means it didn't deliver returns matching its risk, basically leaving money on the table over 5 years. In plain English, think of manager performance as your investment report card. JAAA's manager earned an A by beating expectations, while USHY's manager got a D for underperforming relative to the risk they took. But there's a catch. Beta and correlation show how much your bond fund moves with stocks. Critical when you're counting on diversification to protect you. Let's get into the weeds here. Zero beta means JAAA moves completely independently of stocks. It's built for safety, not riding the market's ups and downs. Let's break this down further. A 0.3 beta means this bond fund moves with stocks. That's unusual sensitivity for fixed income investors to watch. In plain English, here's the seesaw analogy in action. When stocks tumble, JAAA stays balanced while USHY tips right down with them. That's correlation masquerading as diversification, not real protection. Let's zoom in on this. A 0.2 correlation to the S&P means JAAA moves almost independently from stocks. That's genuine diversification you can actually use. Here's the thing, though. USHY's 0.7 correlation means it moves with stocks most of the time, not quite the diversification bonds usually promise. In plain English, here's the dance floor reality. JAAA moves independently, giving you real diversification. USHY? It just mimics stocks. When you're building a balanced portfolio, that independence matters. Let's break this down further. More holdings means you're spreading bets across more companies. It's the classic trade-off between playing it safe or going all in. Let's unpack this a bit. USHY owns almost 2,000 individual bonds. That's maximum diversification, protecting you from any single company's collapse. Now for the real question. JAAA keeps it focused with 483 holdings, concentrated enough to matter but diversified enough to sleep well at night. In plain English, here's the thing about diversification. USHY spreads your money across 4 times as many bonds as JAAA. When defaults hit, that wider egg basket means each loss stings a lot less. Here's where things get revealing. Both funds manage massive capital pools here. That scale signals strong investor confidence and ensures you'll have plenty of liquidity when trading. Now, let's put this in perspective. Both funds manage about $25 billion, giving you the same institutional backing and easy trading, whether you choose either one. So here's the bottom line. JAAAs for safety seekers, while USHYs for those chasing bigger yields with bumpier rides ahead. In plain English, here's the bottom line on choosing your fund. JAAA helps you sleep well with steady, predictable income. USHY pays more cash today, but you'll be wide awake during market crashes. Let's take a closer look. This disclaimer protects everyone. Do your own research and consult professionals before investing. But wait, there's more to this story. Want even more bond fund battles? Hit that subscribe button for weekly data-driven ETF breakdowns delivered straight to you.